All right, welcome to today's Explainer. Look, today we are tackling a massive financial anomaly sitting right at the intersection of two of the biggest trends on the planet, artificial intelligence and cryptocurrency. We're going to break down the USD.AI protocol and its CHIP token to answer one really simple question. Is this actually the future of financing AI infrastructure, or is it just a highly structured trap for everyday traders? Let's dive and find out. Let's kick things off with a number that literally screams anomaly: 585%. You see, just days after its launch, the CHIP token generated a 24-hour trading volume that was nearly 6 times its entire market capitalization. To put that into perspective, Bitcoin usually sits at around 5%, and Ethereum is somewhere around 15%. So a 5.85 to 1 ratio, that's absolute chaos, and it's a huge red flag telling us we really need to look closer at what's going on behind the scenes. So, to figure out how we actually got here, let's map out our investigation. We'll start with the AI compute narrative, then explore the launch and crash, go under the hood, examine the valuation disconnect, and finally, zoom out to cover the retail trap.
Okay, moving right into Section 1, the AI compute narrative.
Before we get into all of the turbulent market data, we really need to understand the massive expectations here, because honestly, the story is undeniably compelling. So, what exactly is USD.AI? At its core, it's a permissionless lending protocol trying to bridge physical silicon and digital finance. The idea is that data centers can tokenize their high-end GPU clusters and then borrow against that hardware to get instant liquidity.
The whole thesis driving this massive hype cycle basically boils down to one bold claim: GPU power is becoming more valuable than oil. I mean, building these giant AI data centers requires huge upfront capital, right? And traditional banks are often way too slow to fund them. This is exactly why we're seeing both retail and institutional money completely swarming this intersection of AI and decentralized finance. And you know, this narrative isn't just a bunch of internet hype either. It is validated by some serious traditional finance players. Wall Street research desk Cantor Fitzgerald has featured them. They secured infrastructure support from federally chartered crypto bank Anchorage Digital, and they even established a settlement partnership with PayPal's PYUSD. So, on paper, the whole thing looks absolutely rock solid.
All right, let's shift gears to Section 2, the launch and crash.
Despite that strong fundamental narrative we just talked about, the token's market debut was a completely different story. It created a classic and frankly brutal boom and bust cycle. Early ICO participants got in at just 3 cents. By April 22nd, the token hit a low of 5.5 cents, but then, the very next day, it rocketed up to nearly 14 cents, and then reality hit hard. In less than 36 hours, a 32.8% drop completely wiped out the late buyers who were chasing the pump, while early investors were still sitting comfortably on 140% gains. This brings us right back to that extreme volatility we touched on earlier. Generating over $1 billion in 24-hour trading volume on a tiny $185 million market cap? That is not organic growth. That type of ratio screams of forced liquidations, leveraged unwinding, and early whales cashing out at the direct expense of retail momentum traders.
Now, for Section 3, under the hood.
Now we're going to peel back the layers and look at the objective on-chain data. And here's where we find some severe cognitive dissonance. The grand expectation is that this protocol is out there actively financing decentralized AI right now. But the reality? Out of their roughly $650 million locked up, 99% is just sitting in boring, standard U.S. government treasury bonds. At the time of this data, only about $1 million had actually been deployed into real hardware loans. So you have this cutting-edge AI revolution, and it's mostly being funded by treasury bills. Kind of wild, right? So the loan utilization rate is staggeringly low, well under 10%. Think about what this actually means. Users are taking on all the inherent, sometimes scary smart contract risks of experimental crypto, but their actual earnings are just standard 4 to 5% treasury bond yields. Investors are essentially paying a massive premium for a cutting-edge AI lending business that literally hasn't scaled yet.
Moving to Section 4, the valuation disconnect.
So why exactly does the token structure heavily favor the protocol over the everyday retail buyer? Well, it all comes down to a massive dilution overhang. You see, only 20% of the total token supply is actually circulating right now. That means any price action we're seeing is happening with just a tiny fraction of the total supply. The other 80%? It's locked up for the team and early investors, just waiting to be unleashed starting in April 2027.
Now, diving into the impartial analyst predictions for 2026, the range is pretty wide. We've got a bearish scenario that drops to around 6 cents if technical support breaks and unlock anxiety really sets in. The base case targets up to 9.5 cents, relying on slow institutional inflows, while the bullish case is aiming for 15 cents, provided major DeFi integrations succeed. But here's the catch. To maintain even that middle-of-the-road base case, the protocol has to rapidly deploy $100 million in actual loans to validate its multi-billion-dollar valuation.
Next up, Section 5, the retail trap.
Let's zoom out a bit from this specific token to a broader, evergreen psychological lesson about market structure itself. Studies consistently show that 70 to 90% of retail traders lose money. Now, the common myth is that they just didn't know enough about the AI narrative or they couldn't read the technical charts. But the data suggests it's not an information problem at all. It is a structural and behavioral trap.
The exact mechanisms behind these failures are honestly incredibly predictable. First, you've got transaction friction, things like exchange fees and spreads that quietly bleed away your capital over time. Second, emotional position sizing, where traders average down, just throwing more money at losing positions, hoping to magically rescue them. And third, asymmetric holding times, cutting winning trades way too early out of fear, while letting losers run because closing them means accepting the pain permanently.
The really crucial takeaway here is that short-term trading often produces the exact opposite of mathematical logic. People end up with their largest financial exposure during their losing periods and their smallest exposure during their winning ones. These short-term feedback loops reward the absolute wrong behaviors, completely turning trading into a negative-sum game for anyone without strict downside risk management.
And finally, Section 6, Conclusion. As we wrap up this explainer, let's tie this macro psychology lesson straight back to our CHIP token. On one hand, we've got a highly compelling narrative of financing global compute power, but on the other hand, we face the harsh realities of extreme trading volume, low loan utilization, and a massive 80% locked token supply just waiting in the wings. So I leave you with this final thought. Is the AI infrastructure narrative truly strong enough to survive the gravitational pull of that upcoming supply and the inherent friction of retail trading? That's the billion-dollar question every investor absolutely must answer before diving in. Thanks so much for joining me today.